Welcome to the Deep Dive. Today, we're digging into the latest earnings call from Prologis.
Right.
We're really aiming to cut through the noise, figure out how this industrial real estate giant isn't just, surviving, but actually doing pretty well in what seems like a tough environment.
Yeah, it's often called challenging, isn't it?
Exactly. So our mission here is to pull out the key insights, the important bits, to give you a shortcut to understanding how they're managing it and where they might be heading.
Precisely. And earnings calls, well, they're these really critical moments, right? Companies talk directly about performance, about their outlook.
Yeah.
So for Prologis, this deep dive will unpack their Q2 2025 call. We'll extract that key info and talk about what it means more broadly for you, whether you follow the market or a specific sector, or just want to know what's really driving things in big business.
Okay, let's jump right in then. The results snapshot for Q2 2025.
Go for it.
Their core FFO, that's funds from operations, kind of the key cash flow metric for REITs like Prologis.
Right, like earnings per share for other companies.
Exactly. So both including and excluding net promote income. It came in well above forecasts. We're talking $1.46 and $1.47 per share.
That's pretty solid, beating expectations.
Yeah. And occupancy held up really strong. 95.1%.
Wow.
Which is only down like 0.1% from the last quarter. Barely a dip.
And that number itself is impressive, but how does it compare?
Well, here's the kicker. That 95.1%, it actually beats the wider market by, get this, 290 basis points.
Okay, so significantly outperforming.
Definitely. And they also showed real strength in rent change and same-store growth. So what's that performance really telling you?
Well, that outperformance on occupancy plus beating the FFO numbers, it's a powerful signal, I think. It suggests that despite this challenging environment, management used that term.
Right.
Their locations, the quality of their buildings is just really sticky. People aren't leaving.
Okay.
And management mentioned something interesting. Their customers, especially the big ones, are increasingly looking past the headlines.
Looking past the headlines. What does that imply?
It suggests a shift, moving away from just reacting to short-term economic jitters,
Right.
towards making longer-term strategic decisions, major players positioning themselves. That's a pretty compelling narrative right now.
That shift in mindset does sound critical. Okay, let's dig a bit deeper then. Specific financials that really highlight this.
Okay.
Rent change. They managed to capture an extra $75 million in net operating income, NOI.
That's the income from the properties themselves.
Exactly, after expenses. And a really robust 53% of that was on a net effective basis.
Meaning sort of the average rent over the whole lease term?
Yeah, factoring in any free rent or incentives. And 35% on a cash basis.
Okay.
This leaves their overall lease mark-to-market, basically the gap between current rents and new market rents, at a healthy 22% by the end of the quarter.
Still plenty of room to grow rents on renewals then.
Seems like it. Now, same-store growth. 4.8% net effective, 4.9% cash.
Also strong numbers.
They are, though we should probably mention there are still some non-cash accounting adjustments from M&A back in 22 and 23 impacting these.
Right. By about 100 basis points, roughly.
Yeah, roughly that much.
Yeah.
Okay, shifting gears a bit. Capital deployment. Big numbers here. Over $900 million in new development starts.
Wow, $900 million.
And get this, nearly 65% of that was build-to-suit projects. So built specifically for a committed tenant.
Across the U.S. and Europe.
Yes. And they even signed another 3 build-to-suits after the quarter ended. Doesn't that just scream confidence?
Oh, absolutely. It's a huge vote of confidence. And what's really compelling about all this build-to-suit stuff is that it shows long-term commitment. Their first half total, $1.1 billion in build-to-suit starts. That's the biggest first half they've ever had.
Ever. Okay, that's significant.
And here's where it gets particularly interesting, I think. It includes a massive $300 million investment in a data center development down in Austin, Texas, for a top hyperscaler client.
A hyperscaler. So one of the huge tech companies.
Exactly. These aren't just speculative buildings hoping someone shows up.
Right.
These are major customers making multi-year, really capital-intensive decisions, despite all the sort of macroeconomic noise out there.
So they clearly see a fundamental need for this space, noise or no noise.
That's what it suggests, yeah. An undeniable need.
And this strategic long-term view, it's not just in the building themselves, is it? It seems to go deeper into their infrastructure.
Definitely.
Let's talk about power. Their power procurement efforts are pretty ambitious.
They really are.
They added another 200 megawatts.
Yeah.
That brings their total in advanced stages to 2.2 gigawatts.
That's a huge amount of power.
It is. Plus, they've got another 1.1 gigawatts fully secured and 300 megawatts actually under construction right now.
So they're really leaning into the energy side.
Absolutely. And their energy business, specifically solar, they're aiming for 1 gigawatt of solar production and storage by year end. They already have nearly 1.1 gigawatts either running or being developed. Now, they did acknowledge some recent U.S. legislative changes might reduce incentives a bit, but they still expect upward pressure on energy prices generally to keep returns looking healthy.
So the economics still work, even with policy changes.
That seems to be their view. And supporting all this, a really robust balance sheet.
Which is crucial.
They closed $5.8 billion in financing activity. That included recasting a big $3 billion global credit line at a lower spread.
Saving money there. Good move.
Yeah, and it contributes to having over $7 billion in liquidity. Plus, they expanded their commercial paper program with a new €1 billion facility.
So plenty of financial firepower.
Loads. So these aren't just real estate plays anymore, are they? It feels like they're positioning themselves as a critical infrastructure partner.
Precisely. And that really brings up a key question, doesn't it? What do these big strategic bets on power and energy tell us about their vision? It's beyond just logistics real estate now.
It seems like a fundamental shift.
It really does. They're not just building warehouses. They're actively creating this distributed energy platform.
Interesting.
Now, it's worth noting their open-ended funds, they did see some net outflows, about $300 million this quarter.
Okay, so money coming out there.
Yeah, but you have to see that against the backdrop of their teams apparently developing new strategic capital offerings. They hinted they'd talk more about those soon.
So maybe new ways for investors to get involved are coming.
Potentially. It's all part of that broader strategic development, which is really key to understanding where they're going long term.
That broader strategy is fascinating. Let's place it against the current market backdrop then.
Okay.
How are general conditions looking and how are customers actually behaving?
Well, the overall market, things softened a bit in Q2. Market rents were down about 1.4%.
Okay.
And property values were, well, basically flat.
And absorption. How much space was actually taken up?
U.S. net absorption was pretty subdued, around 28 million square feet. And market vacancy ticked up slightly to 7.4%.
So some headwinds there in the general market.
Definitely. But despite those indicators, Prologis noted customer sentiment is more like recalibrating, not retreating.
Recalibrating, not retreating. What does that look like in practice?
Well, encouragingly, their leasing pace actually accelerated through May and June. June was their strongest month.
Okay, picking up steam towards the end of the quarter.
Exactly. And their leasing pipeline deals they're actively working on is at a record high. 130 million square feet.
Wow, 130 million. That's huge.
It is. It's up 19% from a year ago. Now, this reflects both, significant interest, but also that decision-making times are stretching out a bit.
Taking longer to sign on the dotted line.
Yeah. But the pipeline itself looks really diverse. Different deal stages, different types of deals, various customer industries. They noted growth in larger deals, over 100,000 square feet, and more activity from 3PLs.
Those third-party logistics guys.
Exactly. The ones handling warehousing for others.
So what's the big takeaway from that demand picture? It sounds a bit nuanced.
It is nuanced. You're right. New leasing is slower, which kind of makes sense when bigger investments are involved.
All right.
But renewal activity, that's still exceptionally healthy. And we're seeing companies use more of their existing gray space, underutilized capacity.
Right.
And also relying more on 3PL capacity. That could suggest there's quite a bit of pent-up demand building.
Like water building behind a dam, maybe?
Something like that. And look at their build pipeline still full. Over 30 projects, more than 25 million square feet they're actively discussing.
Okay.
To me, that level of activity, it really shows larger customers are strategically consolidating, getting ready for future growth. They seem to be moving past that feeling of constant uncertainty.
They're not just hoping anymore. They're actually building for the future.
Precisely. They're building.
And that confidence, I guess, is reflected in their updated guidance for the year.
It seems so. They actually increased and narrowed their guidance ranges.
Which usually suggests they have better visibility. Right. Maybe things feel a bit calmer than they did back in April.
That's the typical interpretation, yeah. Better visibility, calmer environment.
So what are the specific numbers they're guiding to?
Okay. Average occupancy for the full year, they're guiding between 94.75% and 94.25%.
Still very high.
Very high. Rent change is expected to stay strong, averaging in the low to mid 50% range for the whole year.
Wow.
Same store NOI growth, 3.75% to 4.25% net effective, and 4.25% to 4.75% on a cash basis.
Solid growth. Do they mention why it might slow down a bit in the second half?
They did. They flagged a few things. Tougher comparisons versus last year, a bit of an occupancy drag, and some one-off items from 2024 rolling off.
Okay, makes sense.
And development starts at their share. That guidance increased significantly. Now $2.25 billion to $2.75 billion.
That's a big jump. Driven by?
Reflects those additional data center starts we talk about, plus continued success winning build-to-suit deals.
Got it. And the bottom line, overall earnings guidance.
GAAP earnings, the standard accounting measure, they expect $3 to $3.15 per share. And core FFO, excluding that net promote expense, is guided to $5.80 to $5.85 per share.
Which is an increase from before, right?
Yeah, about a 4.5-cent increase at the midpoint, mostly driven by higher NOI and those strategic capital revenues.
So those are strong numbers, strong guidance.
Yeah.
But how realistic is that outlook given the economy is still, well, a bit unpredictable?
That's the key question, isn't it? Management tackled it directly. They said they feel great about the business looking out 2 to 4 years.
Okay. Longer-term confidence.
Yeah, even while acknowledging the short-term choppiness, as they put it, they think any business that's delayed now will just translate into future growth down the line. And they believe in this FOMO dynamic.
Fear of missing out.
Exactly. That once tenants start struggling to find the spice they want, activity will really pick up.
Interesting. And what about vacancy rates?
They made an interesting point. The current 7.4% market vacancy rate, they think that's probably near the peak for this cycle. Historically, they said 5% vacancy is kind of the magic number where you get significant pricing power back.
And they think we could get back there.
They suggested maybe in a year or two as demand normalizes. And for context, 7.4% vacancy, historically, it's not actually that high. It's been higher almost half the time in the last 25 years.
So more like rebalancing than a crisis.
Exactly, a market rebalancing.
What about bad debt? Any concerns there?
It is elevated compared to normal, yeah. Running around 35, 40 basis points versus maybe 20 historically. So higher, but seems manageable.
Okay.
But here's a really interesting twist. They said, in aggregate, their defaults have actually been NPV positive, net present value positive.
Meaning they actually made money from defaults.
How? Because they could release the space relatively quickly at today's higher market rents, and that benefit outweighed the lost income and downtime from the default itself.
Wow, so even a default can become an opportunity in this market.
In some cases, yeah. Pretty remarkable.
Okay, let's quickly touch on geography. Where are things looking strong or weak?
Internationally, things are generally outperforming the U.S., Europe, Latin America, especially places like Mexico City and São Paulo.
Okay, and within the U.S.?
Interior markets are still trending strongly. Coastal markets are more mixed.
How so?
Southern California, they flagged as weak right now, but they think it has strong long-term fundamentals for a bounce back. Southern Florida and the Washington, D.C. area are showing more resilience. And then the Midwest and Sunbelt markets, think Indianapolis, Dallas, Houston, Nashville, Atlanta, those seem to be firming up.
So still focusing on key hubs.
Absolutely. They reiterated their focus on their core 31 U.S. markets and 75 global consumption centers. That covers about 78% of world GDP, they estimate.
Sticking to strategically vital locations.
Exactly. And on the buying side, the transaction market is still active, but they're not just chasing deals. They mention focusing on value-add acquisitions where they can get better returns, maybe 150, 200 basis points higher, rather than just buying stable assets at low core returns.
So disciplined deployment.
Very disciplined, still focused on data centers, build-to-suits, and only building speculatively where the market dynamics really justify it.
Okay, great overview. Now, as we start to wrap up this deep dive, let's shift to our segment where we toss around a, shall we say, audacious but plausible idea.
All right.
Purely for intellectual consideration, of course. This is absolutely not financial advice.
Understood. Okay, so based on everything we've just discussed from this call,
Yeah.
a really compelling, maybe provocative, long-term idea could be this. Aggressively buying industrial REITs that have a clear strategic focus on the combination of power and land.
Okay, power and land, go on.
Specifically, taking an outsized long position in this company, Prologis, actually makes a lot of sense in that context.
Why specifically them, based on this call?
Well, think about it. Management's deep conviction in that 2 to 4 year outlook. They're record build-to-suit activity driven by big, committed customers. And these massive investments they're making in data center power infrastructure and those behind-the-meter energy solutions.
Right, the solar and power procurement?
Exactly. It all points to a future earnings stream that feels, well, maybe undervalued by the market right now.
Okay, so that's the plausible part. What's the audacious or outrageous part?
The outrageous part is betting on the market having a pretty rapid FOMO correction.
The fear of missing out kicks in hard.
Yeah. As that water building behind the dam, that deferred demand we talked about, finally breaks, think about industrial automation potentially driving a 5-fold increase in power needs for warehouses.
5-fold, from like 5 kilowatt hours to square foot to maybe 25.
Something like that order of magnitude. And utilities might struggle to keep pace with that kind of demand surge.
Okay.
So a company like Prologis, with its huge 14,000-acre land bank and its proactive energy solutions already in motion, they're uniquely positioned. The market, arguably, is underestimating the leverage they'll gain by being a critical partner in this whole industrial electrification and automation wave.
So the trade idea is basically betting they become an indispensable infrastructure player, not just a landlord.
Essentially, yes. And targeting, say, 30-50% outperformance compared to the broader market over the next 18-24 months as this multi-year trend really picks up speed, regardless of any short-term economic wobbles.
Interesting. A bold call based on power, land, and long-term trends.
That's the idea. Audacious but plausible.
All right. So wrapping this all up, what's the core message for you, the listener?
Well, despite some choppiness out there in the short term, Prologis' Q2 performance really shows impressive strength. There's a clear strategic focus on these big long-term trends, data centers, automation, energy, and they've got a very strong balance sheet to back it up.
Yeah, and the underlying demand for well-located logistics real estate, it still seems incredibly robust, even if decision times are longer.
Definitely.
And just to reiterate very clearly, this deep dive, everything we've discussed, it's purely for informational purposes. It is absolutely not financial advice.
Yeah. We really just encourage you to think about the implications of these powerful trends, energy, automation, supply chains, and how companies like this one are strategically adapting to what's clearly a changing landscape economically and logistically.
Well said. Thank you for joining us on this deep dive. As we've seen, the future of logistics, it seems it's not just about square footage anymore. It's really about power, strategic location, and that long-term vision.
Absolutely.
So what are you seeing out there in the headlines that might be tomorrow's hidden opportunity? Keep digging, keep exploring, because as we always say, there's always more to uncover.